Nebius has been slammed more than 30% since October, falling from $141 to the low 90s. For momentum traders, this looks like a disaster, but for long-term investors, this might be one of the best setup moments we'll see in the AI infrastructure space for years. The sell-off wasn't caused by collapsing fundamentals. It came down to two narrative-driven fears: dilution anxiety and a cooling in the AI infrastructure trade. Q3 earnings triggered the initial dip. Yes, revenue grew an insane 355%, but it still came in slightly below expectations, not because of weak demand. Quite the opposite. Nebius was literally sold out of GPU capacity. The bottleneck wasn't customers. It was the physical process of powering, racking, and deploying new compute. Then came the share offering at $92.50, which spooked investors. But the truth is simple: Nebius needs capital to keep building. This is an ultra capital intensive business, and without fast expansion, they physically cannot meet the demand already in front of them. The macro backdrop also shifted. Wall Street is no longer rewarding companies for simply hoarding GPUs. The narrative switched from land grab to show me the money. And then there's the power panic. As securing gigawatt scale electricity is becoming a major industry choke point, these sector-wide concerns hit all AI infrastructure stocks, not just Nebius. But here's the part most investors are missing: Nebius has already secured most of the growth required to justify its valuation. Starting in September, Nebius locked in two gigantic hyperscaler partnerships. Microsoft, up to $19.4 billion for dedicated GPU capacity from a New Jersey data center. Meta, roughly $3 billion for a similar long-term infrastructure build-out combined. That's over $22 billion in contracted potential, almost equal to Nebius's entire market cap. In other words, the market is pricing Nebius at around 1 times its backlog, which almost never happens for a hypergrowth company. These deals validate Nebius's tech stack and remove a massive chunk of execution risk. They're not building data centers and hoping someone shows up. Microsoft and Meta already did show up, with contracts worth more than the entire company. Looking ahead, management expects a $7 to $9 billion ARR run rate by the end of 2026. Hitting the lower end implies roughly $3.5 billion in revenue that year. Very achievable given the backlog alone. For 2025, they guide to $525 million revenue and $1.05 billion ARR. And for 2027, even assuming zero new ARR and simply working through the backlog, Nebius's revenue base keeps expanding. From there, we can calculate the growth needed to justify today's stock price. Using a 10% WACC, 3.5% terminal growth, and a mid-term EBIT margin of 20 to 30%, Nebius only needs about 12.6% annual growth after 2027 to be fairly valued. Given their contracts and industry tailwinds, that's extremely conservative. If Nebius grows closer to analysts' expectations, roughly 35% annually after 2027, the company could be undervalued by up to 132%, implying a fair market cap closer to $52 billion. Of course, there are risks. Securing 1 gigawatt of power is one of the hardest challenges in the industry. CapEx needs are enormous, and more dilution is possible. And though Nebius is Dutch-based today, its origins as a Yandex spinoff could still create geopolitical hesitation among some investors. But the big picture is clear. A 30% decline on a company whose signed AI infrastructure contracts equal its entire market value is not normal. It's an opportunity. Nebius has a structural demand floor that few companies in the AI boom can match. That's why this sell-off looks far less like a warning and far more like a potential lifetime entry point. I rate Nebius a strong buy at these levels.